All right, welcome back. Let's take a last look at this module. We have one more video. And what we're going to be looking at are a couple of things. Two things I wanted to focus in on are the multi-product firms, and we'll be talking about sales mixes when we have multiple products that we sell, which is more typical than just having a single product. And we'll discuss finally operating leverage to go with that. So if we're looking at our mix, on a multiple product break even, we actually use this ratio. We use that percentage. The previous video that showed, yep, we have a per unit. You say, wait a minute, I've got two or more products. What's my per unit cost? What's my per unit analysis? And we can do a weighted average per unit, which we do, or we can just use that percentage. So we're going to be diving deeper into percentage. So we do divide our fixed cost by the contribution margin ratio, and it could be a weighted ratio. If we have a desired profit, we go ahead and have our fixed cost plus that target profit or desired profit, and we can analyze coming up with the actual target dollar sales volume associated with that. So we're talking about not units on our break-even point or targeted dollar sales volume. We're talking about total sales dollars, and that's pretty powerful. So sales mix is a relative portion of units or dollar sales that are derived from each product. When the sales mix is constant, and that is an assumption we make, the basic cost, volume, profit model can be used very effectively. When it's not constant, you must determine an average unit contribution margin or average contribution margin ratio for each alternative mix. So we might have some multiple calculations here. So let's look at two things we're making, not just ice cream bars, but let's say we're making popsicles too. We have a selling price per unit. Yep, they're different. Variable cost per unit. Sure enough, they're different. We do have a fixed cost combined for all of them. Same machinery, same equipment, same facility. Then we have sales revenue based on a certain level of sales, as is those $5,000 sales we're anticipating for each. The variable cost comes out. We have a combined contribution margin associated with that. And if you look, we have a 45% contribution margin ratio and a 50% contribution margin ratio for the two different products. So we take our average contribution margin and we have a per unit and divide by 2, and then we have a dollar amount here, 65 cents. And we take the average contribution margin of 65 cents into that total fixed cost, again, based on that mix, based on that sales mix and the volumes of both, we're anticipating that we would have to sell 5231 units. Well, in this case, we're 50-50 on units, so half of the units would have to be ice cream bars, half would be popsicles, since we had that 50-50 sales mix. When we went back here, we're looking at 5,000 unit sales of popsicles and 5,000 units of ice cream bars. If we had 6,000, 4,000, we'd have a 60-40 calculation that we'd have to make over here rather than a 50-50 at the end to find out what we needed to do. So if the sales mix changes to 4-1, let's look at that example. No longer 50-50, but we have 4 of the ice cream bars to 1 of the popsicles. Then we have to have our ice cream bars, 80% of our ice cream bars and 20% of our popsicles. So we have a different unit mix associated with that, but because they're very rarely going to be equal, but we want to understand how that flows. And then we take a little closer look. We're using that break-even analysis, and we have an average contribution margin ratio. So sales mix of 10,000 to 4,000, 71.29 is roughly. The total contribution margin is 6,500. So we kind of break that down out of the total 14,000 of total revenues, total sales, and we get 46.464 or 46.4%. And then, so this is an average per unit cost associated based on the sales mix that we have. And then we look back and say, yep, we're going to multiply that out, and we come up with a mix of the actual dollars that would be sold based on that, or need to be sold for break even. So that's our analysis. That's looking at the break even. That's looking at a different sales mix. And then if we change the sales mix, we have to go back and recalculate what the margins look like, come up with a new ratio, come up with a new calculation, multiply it out, and to target what we need to sell for ice cream bars and for popsicles. And this is making me hungry. Let's go now down to operating leverage. And our operating leverage, it gives us a degree of sensitivity measure. It's a measure of the extent an organization costs are fixed. So how heavily are we looking at fixed costs? Because if we have higher fixed costs, we said this before, a higher level of fixed costs, if we only sell a couple of units, we lose big time. If we sell a whole bunch of units, every additional units, we make more part of the profit because our variable costs are lower and our fixed costs are higher. And by the way, this is the trend. Automation is causing us to spend a whole bunch of money on robotics, a whole bunch of money on fixed costs and infrastructure. And ideally, at that point, if we're spending more money on the fixed costs, we're able to spend less money on the variable costs, like labor. And labor is going way down. In the good old days, 90% of the US was an agrarian economy. Now it's less than 5%. So you say, wait a minute, if we have a whole bunch of labor shift from farming, then it went to the industrial age, now we're in the fourth industrial revolution, and getting away even from the manufacturing into a bunch of services and analysis. There's transition and change. People are still working. And if we have low unemployment, if we're under 5%, we have been for a long time, since the initial COVID push, we have been now, and we continue to be, so that lower unemployment, there's still a lot of people working. And not just because they're not farmers doesn't mean they're not working. Same thing, just because they're not manufacturing does not mean they're not working. So our operating leverage ratio, we take our contribution margin, CM, divided by income before taxes. And that's going to determine if the high, again, contribution margin, revenues minus variable costs. So if it's higher variable cost, we have a lower contribution margin. If we have a lower variable cost, we have a higher contribution margin. So a high degree of operating leverage, high portion of fixed cost is indicated. So if we look here, we have high operating leverage. We have, if we increase sales, the per unit, we have a whole bunch of profit that we can make. But we also have a higher risk of loss because we have these fixed costs we need to cover. It's like when we talk in financial accounting, if we had a whole bunch of debt versus equity, the more debt we had higher risk because we had to pay the interest. If we had lower debt, we could determine whatever dividends we wanted to dish out. We wanted to pay out, but we didn't have to pay dividends. We have to pay interest. Well, here, if we have high fixed costs, we got to have the equipment. We got to pay for it. We got to cover it. And then if we have lower volume, again, it's a higher risk, higher potential for loss to go with that. And it's just some measurings. If we go look and say, well, what happens if sales drop? Which company suffers more? We have sales drop of 20%. Okay, so we have a decrease in profit. We had a 36% decrease Taco Express versus a 64% decrease at Mia's Cantina. And if we're looking at Mia's Cantina had the 22,000 in fixed costs, where Taco Express only had the 8,000, but much higher variable costs. So that flipped. We had 22,000 variable costs for Taco Express, 8,000 variable costs for Mia's. So if we sold more, yep, variable costs didn't cost us much more. We were covering our fixed costs. We're on our way. So if we reduce sales, if we reduced the profit would be reduced higher when we have when we're worried and we have the different levels of fixed costs and variable costs. So that gives you a bigger picture. Operating leverage is a powerful concept, and we want to be having a pretty good understanding how that all works. Thank you for participating. I look forward to seeing more of you very shortly.